Fresh fears over a recession-inducing credit crunch are spurring bond bulls to ramp up bets that the Federal Reserve will embark on the most abrupt policy shift in almost 4 decades. Just minutes after Wednesday's Federal Reserve interest rate hike, traders intensified their long-standing wagers on imminent cuts as renewed turmoil in regional banks sent shivers across Wall Street at the most anxious markets priced in a policy about base as soon as in July. And U.S. employment data released Friday tempered that view, and next week's inflation reports are expected to show scant progress toward the Fed's 2% target. Yet key barometers of economic health, which traders have largely ignored for years, are cause for concern. The Fed's quarterly senior loan officer survey is one. Others include a gauge of small business sentiment and use of central bank emergency facilities. So while headline data suggests the U.S. business cycle is proving more resilient than expected, keeping inflation hot and pressuring bond yields, the financial outlook may be darkening. This is the minute bread points. Credit tightening trend continues. It's going to be difficult to sustain strong economic growth. Eventually, lower rates are going to be needed, said Kathy Jones, chief fixed income strategist at Charles Schwab & Co. How soon is the question? A rate cut just 2 months after a hike would be the first time since October 1987, when then Fed Chief Alan Greenspan slashed borrowing costs in the aftermath of Black Monday. This time around, the Fed faces a particularly tough balancing act with a still resilient labor market, elevated inflation, and increasing financial risks. Announcing last week's decision to increase its prevent target range for the federal funds rate for the 10th straight time to 5.25%. Policymakers said further increases were possible, but for the first time, didn't say they were anticipated. While emphasizing its policy trajectory depends on incoming data, the Fed does recognize there's clearly significant stress within the banking sector, said Roger Hollum, global head of rates at Vanguard Asset Management. Although a systemic crisis has been avoided, challenges are still to be resolved. For bond investors, it spells volatile markets, particularly in the 5-year sector of the Treasury market, which is guided by expectations for the Fed policy rate in the long term. By the end of the week, while bets on a July rate cut had mostly been washed out, rate derivatives continued to anticipate a quarter-point cut by September and a total of 3 by year-end, right? The 5-year Treasury yield moved up or down 15 basis points in a day 3 times this week, falling to 3.20%. Its lowest level of the year on Thursday, and ending the week about 3.41%, displacing the 10-year note as the lowest yielding Treasury security. Gauges of bond market volatility increased without approaching the multi-year highs reached in March. The exchanges you're seeing are intense. Rick Reeder, Chief Investment Officer of Global Fixed Income at BlackRock, said on Bloomberg Television, the only way I've found fruitful has been to fade the extreme. Reeder said he'd sold 2-year treasuries in recent days after the rally, betting that a deep recession is unlikely. Meanwhile, the highest policy rate since 2007 is creating opportunities in short-dated obligations outside the Treasury market, which aren't at risk from the debt ceiling brinksmanship that helped inflate Wood-Bill yields this week. Reeder said he bought commercial paper, short-term corporate debt, at yields near 6%, a rare opportunity over the course of his career. All fixed-rate Treasury yields ended the week more than a percentage point below the Fed's policy rate threshold ahead of next week's quarterly auctions of new 10-year notes and 30-year hybrids and bonds. Those will put investor conviction in an economic slowdown
to the test.
Economic data calendar, May 8. Fed Senior Loan Officer Survey. Wholesale inventories, May 9. NFIB Small Business Optimism, May 10. NBA Mortgage Applications. Consumer Price Index Monthly Budget Statement. Jobless Claims, May 12. Import and Export Price Indexes. University of Michigan Sentiment Survey, May 8. Fed Senior Loan Officer Survey. Wholesale Inventories, May 9. NFIB Small Business Optimism, May 10. MBA Mortgage Infractions. Consumer Price Index Monthly Budget Statement, May 1947. Producer Price Index. Jobless Claim, May 12. Import and Export Price Indexes. University of Michigan Sentiment Survey. Fed Officer Social Media. Fed President Neil Kashkari, May. Fed Governor Philip Jefferson and New York Fed President John Williams, May 11. Fed Governor question in their Seek and Prize meetingly online project. May Minneapolis Fed President Neil Kashkari, May 9. Fed Governor Philip Jefferson and New York Fed President John Williams. May 11. Fed Governor Christopher Waller. Frost you out to attractive at St. Louis to the course together and offering Jages Treasury auction calendar May 13 and 26 week bills May 9-3 and notes May 10 17 week bills 10-year notes May 11 4 and 8 week bills 30-year bond May 8 13 and 26 week bills May 9 3-year notes May 10th 17 week bills